talk to us about this steep sell-off. We have obviously earnings. Some of them were really disappointing. There are trade tensions, Italy's budget wranglings, and Saudi Arabia. How do you distinguish what you're going to concentrate on when you come in the morning these days, Scott?
Well, Vonnie, I think you have to do some research and try to figure out, what is happening. And I think you can break this down into a few basic concepts. We've been talking to our clients for the last year and a half that in 2018, there would be a few things bothering the market. One of which is the Fed going to make a mistake? Another is global growth going to slow? And then another is there going to be increases, wage increases, input increases that are going to negatively impact these really high corporate margins. So, you're later in the cycle, the labor market's tighter, costs are normally rising. And so I think what we're seeing now are some normal concerns. We've had a 2,800 to 2,900 target out there for the S&P since we released the target. And, really, I feel good about that target. I think stocks right now are at or a little bit below fair value relative to where they'll be at the end of the year. So we want our clients in here stepping in, buying at these levels. Now the 200-day average didn't hold, as Abigail pointed out, but you get down in here to 2680 to 2700. That's good support there. The next support's probably the February low. So we have some opportunities here for investors who have plenty of cash on the sidelines and have been underinvested in a lot of this rally. So
sure.
I think if you break it down, you can understand why there's caution out there right now.
But what gives you such confidence when the likes of a Caterpillar comes out, gives a little bit of a warning thanks to trade and other pressures, and the stock drops 9%?
Yeah, I tell you, Caterpillar is the type of industrial stock, and industrials are very sensitive to global growth. So stocks like that swing. They swing quite a bit, and clearly the industrial sector as a whole is probably most sensitive to any of these tariffs. But we would say, our global economists are positive on global growth. They don't think Chinese growth is going to fall apart. They don't think developed international growth is going to fall apart. We should be steady here, somewhere probably close to 3% this year and maybe a touch below next year. We don't think there's going to be an all-out trade war, and we don't think the Fed's going to make a mistake in the next 12 months. So, you have to do some research, make some assumptions, make some calls on those basic concepts to have the confidence to step in here on these pullbacks.
Scott, if I'm buying and you're suggesting to the people watching that they should, what am I buying? Am I buying value or am I sticking with some of the momentum stocks? Tech is under a great deal of pressure.
I tell you, I would really be surprised if value did anything other than outperform for brief periods of time over the balance of the cycle. I think you have to lean more towards growth. I look at it more, Guy, as a cyclicals versus defensives. On the sell-offs, people are going to be hiding in utilities and staples. But if things pan out the way that we think they will, we like industrials. We like the consumer discretionary sector. We like financials. We like healthcare. We don't want our clients hiding. Somewhere out there on the horizon, it will be time to hide, and this cycle will be coming to an end, but we don't think it's right now.
Am I buying U.S. stocks or am I looking at global stocks? Chinese markets down 25% this year for U.S. investors.
I tell you, we do like large cap U.S. stocks, but about 2 weeks ago, we decided to stick our toe into the emerging markets. We thought they had sold off more than what the fundamentals suggest. So our clients, and I think retail clients in general, they are underinvested in anything international, and we thought this was a good opportunity for them to stick their toe in the water, start to bring those allocations up. We think the growth rates over there look better, honestly, than they do here in the States, whether you look at it at an MSCI emerging market index level, or if you look at the sectors making up the emerging markets. So we think that's worthy of it. We're pretty neutral on developed international. I think there's too many uncertainties over in Europe right now. But emerging markets, we definitely recommend that our clients are sticking a toe in the water there now.